we thought of getting you a view regarding Indian markets, taking in perspective what's happening globally. So the voice who's joining us today in my studios is someone you usually catch on ET Now and ET Now Swadesh at 8 o'clock in the morning. That is Anurag Singh, who's joining us. He's not in Chicago today. He's right here next to me in the studios. Anurag,
thank you.
It's amazing. You know, we've been speaking for some years now, but
Correct.
I think 2 year plus.
Yes.
But we were meeting for the first time right here in the studio. So good to have you. And today, you know, interestingly, market rally, sure, we were oversold, all of that. But today's rally is triggered by what is happening in the world. Are you comfortable with yields coming down, all of that, or are you still cautious?
So Ajay, first of all, thank you so much, right? So much of honor and respect I've got from your channel and the Times Network, right? So I appreciate with all humbleness, you know, I take all that. And good to be back in India, right? And you know, usually viewers see me without these specs, but I think I have a distance sight, so I think they see a bit of a change. But so Ajay, I would say I would continue to be cautious, right? And once we discuss those 4 or 5 macro trends that I'm going to pull out, I think we would observe that there is going to be a constant pressure on the 10-year yield of US.
Okay.
And I think even though it might have eased off, but we understand that it's really touching that 5% mark, more or less, right? And so, you know, we have to be very vigilant on that. That's a new development. And I think once the market continues to demand that kind of yields from US 10-year bonds, I think it has a very long-term implication, both for equity market and the
So that's a very contra view. I'll pull up some of the graphics. You may want to have a sip of water by then.
Sure.
What is happening is that Anurag is making a case that yes, there is some amount of easing which is happening as far as global yields are concerned, but this could be transitory. Do not assume that yields will come crashing down and the case for rate hike and all of that. The global issues are not over. Let's pull up the graphics which we prepared for him, especially which makes a point that a lot of easy liquidity situation globally may be over. And easy liquidity, what it usually does is it drives up the asset prices. So that is the point number 1 which you're talking about. I want you to elaborate on that. Why? Because you know, a lot of big HNI traders, retail investors, everybody who follows you, you know, people should not take this easing off of the environment that, you know, all the worries are over.
Correct. So Ajay, let's, you know, the first trend I would say is this, you know, and the trend started in 82, right, when the Volcker kind of claimed a victory on inflation. You know, and it has been underway in the US economy at least for the last 40 years. And I would say it's broadly a phenomena which is also happening across the Eurozone, United Kingdom and all, right? Because in Thatcher days, you know, after that, even they also pursued the same policy. I think the key element there is that the interest rates globally started declining from there, right? So US was pretty much at some 16% to 18%. It started dropping, and what it does, and we rarely, you know, once the graphic comes up, I think we can show that comparison. But you will see a direct correlation of how the interest rates are dropping and the wealth of the households is increasing. And that has been a 40-year-old phenomena, you know, and right to the point till we hit the zero mark. In the past 14, 15 years, we have been at zero. Now, I think the implication there is, Ajay, that, you know, interest rate acts as a gravity to market valuation or any asset valuation, right? So, be it home values or anything.
So, simply put, what you're saying is we should be ready for a prolonged period of elevated interest rates.
At least not zero. Well, at least not zero. Even if it is 2.5 or 3, you know, if we are at 5.5 today, even if we drop to 3, it's not zero.
So that you're making a point for Indian investors and our viewers that flows could remain under pressure because of that.
Well, no, that's flow is a function of how much people are earning and how much are they investing. So flows might still continue to be bright because look, people are earning good enough.
What is your positioning in all of this right now in the market, in emerging markets?
So Ajay, we are now very cautious on emerging markets. I think look at the last, and India is an exception, we'll talk about it, right? But outside India, emerging markets, look at the MSCI 10-year returns, I think they have been sub 3%. So broadly, you will see that, China, Brazil, Argentina, South Korea, they've not really, I mean, they have produced some great phenomenal companies, but market-wise, they haven't produced great returns, right?
What about India, your viewers and followers? Because you always try to give us Indian viewers a a kind of flavor of what is happening in the globe. What does it mean for you here in India?
Correct.
And
correct.
Indian rally to a large extent is fueled by domestic flows.
Sure.
So how should Indian viewers manage their money?
So again, India continues to be that one bright spot. Ajay, we all know that, and we have kind of repeated that enough. I think the limited call out would be that I expect 11 to 12% returns from Nifty at an index level, right?
Okay.
Now that's where my decadal return story comes in, I think, which was being projected earlier, which is that Ajay, very easily, sometimes what we do is we lump for the last 30, 40 years returns together.
Correct.
And then we say, look, Sensex has returned, about 15x, 18x since inception and all of that.
But that's lumpy, right?
That's pretty lumpy, right? What we need to do here is that we need to observe a decadal return, right? So I've divided the returns into 4 decades.
Yeah.
And this is like, so year ending 2001. We saw there's 11% return, and this is what BSE's S&P. This is S&P 500, but if you see BSE Sensex also, I think 1 to 11 was 20%, then it was 12%, and current is of course
this
underway.
is quite variant.
Right?
The point he's highlighting, viewers, is that if you could get back that played back, what he's meaning to say that if there have been a lot of heavy gains on the table in the short term, then for you it is good reason to be cautious. Because decadal return on the average out. So very good periods of return are followed by average or negative return. And right now last 3-4 years have been very good. So why not, might as well be slightly cautious to retain money in your portfolio. It should not be that gains are only paper gains on the screen and nothing comes back home. That's a very important point. So there have been decades of low return, reasonable return and very good return also. And 2001 to 11 was 20 year average.
No, and there is a very elementary reason for it, Ajay, which is that for any investment, most of the gains come in the early part of the investment, right? When the easy pickings are there to be plucked, right? Be it the growth of the economy or the markets, the easy pickings were taken, right? And today, if we see the Indian economy, there are organized banks, there are organized telecom players, there are organized, discretionary players, staples players. So all the easy returns are gone. From here, you have to replicate the economy. So
when we talk about India context, we talk about the golden decade. This one. Then we are talking about 20-year, 30-year period. So are we? Sometimes Indian investors should be conscious enough that there could be periods of brutal volatility as well, and still there could be a golden decade, right? So you should survive this brutal volatility in order to really end the race.
Could be. No, so of course, look, volatility will come with it, right? But ultimately, the investors now need to understand that their expectations have to be anchored to that 12% number,
fair
right?
point.
And that 12% number has 6% inflation, right? So it's still better than a 20% return with 11% inflation, right? So I would say that there is a balance to it. But as long as the expectations are anchored, I think investors would be fine, right?
So so I am not sure how much India piece exists in your emerging market basket, but for the Indian viewer, investor, and someone who follows you, what is the ideal portfolio mix sector which you are overweight on? And between the market cap as well, because there appears to be a lot of interest in small cap, mid cap, but people are not particularly liking large cap right now.
No. So it should be entirely reverse, Ajay.
Okay.
And I think usually, look, so let's come to this premise that about 70 to 75% of the profit pool is captured by the large caps.
Correct.
Any point in time you see Nifty 50, it captures about 70% of the profit pool of India, right? And ultimately, market follows earnings, right? And it's pretty, we see Nifty earnings now at about 850 plus something. And that's why Nifty is still at that level where it is, right? So I think we should, about 50 to 60% or 70%, I would say, still follow large caps, and then small caps can be 20 to 25%. It's very easy to say some of these small caps will become large cap. Well, some will become, but not all, right? So it's a mixed bag, right? So
Wow.
that's a classic mistake people do, and I think it's when investors see 3-year returns, previous returns coming up in small caps, then they jump in, and that's a classic timing mistake, Ajay. You should not do that.
So which are the sectors in India which excite you?
Okay. Ajay, Indian sectors, broadly again, I think I would take, so this morning I met Samir, and I would just borrow from his phrase. There are broadly 3 sectors where to invest in India, especially any developing economy. One is technology, other is banking, and third is your discretionary.
Technology, but market is completely refusing to look at large cap tech here. Yeah. But your US economy, I mean, you have a best view there, appears to be very resilient.
So that is true. One is not all guns will blaze at the same time. That is one point. Second is, you have to buy certain sectors when they are at their lows, right? That's when you get the right price. I was saying when TCS was at 40p, well, that's not the right price, right? But if today, if it is valuable, but you have to understand the enterprise these guys have created, it is unbeatable. There's no, you talk to clients in US, there's no easy substitute for TCS, Infosys or Cognizant, right? They are there, they are providing value, and, they are all cash generators, and they don't have much debt, Ajay. So the point is, whenever the cycle turns, and ultimately, people say don't bet on India and don't bet against India and don't bet against US, right? Buffett says.
Right.
US eventually will bounce back, right?
Okay.
And the spending will again flow to these companies, but then you will try and latch on to those companies when they're getting expensive. That's not the point.
So that is one area of opportunity.
Correct.
All right. Anything else you'd like to?
So outside of that, Ajay, I would say, and I think this is one of the mega trends, which is that now, because the peak globalization is kind of behind us, every country will have to kind of look at creating a strong domestic demand. So what this means is that even a country like India will have to kind of, maybe at a smaller scale, repeat what China did about 20 years back, right? It will have to look at the strong domestic, because look, China in a big way benefited out of this export-led economy. Now exports, and trade as a percentage of global GDP is dropping. It peaked out, about 8 to 10 years back. And now it's the time where India empowers the domestic economy and looks at the domestic facing sectors. So anything with respect to housing, Ajay, and not real estate directly, right? But anything related to housing, spending, homes, cars, home decor, lifestyle, clothing, retail, everything is going well, right, Ajay? So if people are top 15% of India is earning as good as any middle income country, they've got to spend this money. And where will
domestic
they spend?
Focused sectors is something which also you like.
Absolutely. Anything where, so look at, I think my style of this is that look at the consumer. Consumer can look at his own wallet and see where is he spending the money.
Correct.
Annually, if he's earning 10 lakhs, where is the money going outside of taxes?
You can figure out the top bets.
and you can figure out where the economy is spending the money.
All right, Anurag, great chatting today, and thanks very much for dropping by in our studios.
Thank you.